your team runs a particularly long-term book, and I was just reminded of a conversation we had. 5 years is your target horizon for investments. When you turn over the book, which it's naturally going to be a very low turnover book, how do you commiserate that view? And I guess is two-part. One is, do you actually see investment? Do you actually exit before a 5-year mark? And how often does that happen? And number two is, how do you commiserate that with investors coming in at different times or different points of an investment idea, either at the beginning, middle, or close to the end of it, which may change their investment experience with your strategy?
We try to tell investors that a journey with CDAM should be at least 5 years. And the reason for that is that if we look at a simple total shareholder return model, where all returns are based on three things. One is the change in the multiple. Second is the earnings per share growth that we focus on. And the third is the dividend, which is not as important to us, but it does factor into the price of the indice, we'll say. We find during the first 3 years, the change in the multiple explains most of somebody's return. And that's, people looking at a re-rating in their stock, or it gets popular and you see the multiple go from 15 to 20. And that is where most people live, in that sort of shorter term area. But if you want to focus on the earnings per share, it's not until that 5-year area where earnings per share emerges as the dominant driver of returns. And so we tell people, we are buying acquirers. These people will acquire consistently over a long period of time. Their earnings per share will grow very consistently at the high teens for a long period of time, but you will get noise in the multiple for the first few years. We try to buy them cheaply. We think that's our job as active managers, but we can't prevent things like events in the market from happening, and we have to be prepared for drawdowns. But over the long term, once you're past 5 years, the earnings per share growth will explain 85 to 90% of the return. So we really do focus on that, is that if you're with CDAM, think in the long term. In a number of ways, I think that's the way we should be thinking about stocks in general. When people say, oh, go buy the index and you'll be safe, don't go to a manager. Go buy the index, but you have to hold it for 10 years because the index is going to go up and down too. Equities are the longest duration instrument we can buy out there as investors. It doesn't have a finite timeline. And so to really make it work, you need to be past 5 years. Now, of course, we know there's investors doing some amazing things over the short term, and that's a completely different game. And I think that's a very rare person indeed. If you can catch the right stock and at the right time, it's of course going to have wonderful returns. But we can also prove that I can have a very, very boring company producing very consistent returns for a very long term that will crush all of tech and everything else combined. And you will sleep at night much more because there's no debt and you know what the CEO is doing every day. So we really are practitioners of the long term. We think it's a real edge.
Yeah, it sounds and it's implied that this is actually a pretty good time given the valuation and the compression in the market. But I want to step back a little bit. We talked about, this is a topic that's close to my heart, which is integration, business models, distribution models. I started my early career with Dell computers back in the day when the direct model was the most disruptive form of distribution. It was so disruptive that it shut down system integrators. It forced IBM to completely rethink their logistics model. The last example that you gave talked about decentralization rather than integration. What other companies are you looking at right now? Last conversation that we had, you mentioned a firm called Boyd, which is a very successful Canadian company that acquires and follows this type of decentralized route. Maybe you can walk me through that model and we can peck at it.
It's a great example of what we do and why this opportunity exists. Boyd, as you say, they paint and repair cars, and their model is to acquire small auto body repair shops, whether you have 1, 2, 3, 5, or 20 across North America. So although they're based in Canada, most of their operations are in the US. And again, they're run by a head office of about a handful of people. And their idea is there to go to the owner of the auto body repair and say, you've been in business for 15, 20 years, or in many cases, much longer than that. Your business is very solid. It runs very well. We have all the insurance contracts just like you do. So if somebody's getting their car repaired through the insurer, that you're on that list. So we'd like to buy your business. If you're interested in selling it, we're going to pay you 4 or 5 times your cash flow. And in most cases, a business owner who's coming down to the end of his career, or he's looking for a liquidity event, or there's a personal situation, or there's no succession plans, there's a long list of things why private business owners will do that. And they'll sell the businesses to Boyd, and Boyd will say, you can keep your name on the door. You can stay employed. We'll pay you a salary. We're not going to fire anybody. We
So it's
love
not
the
a
way
franchise model then, right? They don't
it's not
rebrand it.
they don't rebrand it at all. And they think
Wow.
it's really good for the communities. And many times the owner would say, I don't want to sell to that other peer because he's going to fire everybody. He's going to rebrand. And this is something I built in the community my whole life. And I want it to be a legacy. And someone like Boyd will say, that's fine. And other people may say, we don't care. But if the owner wants to keep his identity, then they let him keep the identity. And when you think of buying a business that is growing like the economy, 3 to 5% in good cases, but you're able to buy that business at 4 or 5 times cash, where you're making 20 to 25% right there. And then Boyd's able to help with procurement and supplies and everything else. So they may be able to squeeze a little bit more out of it. And that's why a company like Boyd, who's been going for 23 years, is able to generate 29% annualized returns. And you can see that's a 23 years. If you just put your money in Boyd, you would have done better than Berkshire. Yes. So it's some extraordinary returns for those people. And their model is simple. We buy you for this price. We don't pay much more than that. You keep your business operating. Just please send us the cash flows. And we think that's wonderful. And of course, there's a little bit more complexity to that. But on the surface, that's the type of business and that's the type of people that we are trying to get involved with in the public markets. So we can give people access to that type of business in the public markets. And it's not something that people realize they can get access to. And it does produce wonderful long-term returns. But I will say, just to our earlier comment, Boyd has had 2 or 3 instances of 30 or 40% drawdowns because of market events. And if you had left at that point, you would have missed all the compounding, back to our earlier discussion.
Fascinating. So is it fair to say that the way your team looks at it is track record? The catalysts are these events. You wait, cash is ready, deploy it when these events massively misprice some of these compounders, as you call them. And then you take a long-term 5-year approach to building that relationship.
Exactly. And we do turn the book over about 20%, which matches about a 5-year horizon. That happens because other things, that the company may run out of TAM, so that addressable market. Let's say Boyd still has thousands of auto body repairs they could roll up. But let's say for whatever reason, they said there's only hundreds. We would exit that position because he doesn't have much runway left. So you could do it because the company is running out of their acquisition capability. You could exit a business because somebody bought it, which happens to us quite often. Or we could exit a business because we find something a significantly better return, which generally happens during big market dislocations. We substitute one company for another, and that creates some sort of turnover. But in most cases, what we want to do is sort of fire and forget and say, this business, we've done the research on, it is a 10-year track record. If they do exactly what they've been doing for most of their career, we're going to be just fine. There are a couple really interesting, buttons out there that we need pressed in order for this to work. One is management ownership. And we found and it's no surprise, you've been an investor for a long time, those who are correctly aligned run their businesses very well.
Yeah.
And we do think there's a threshold in this model, and you cannot have zero at all at any time. And you will often find that all of the management teams that we deal with, they keep and acquire all the shares they have. And when you step back and you think about it for a moment, you say, of course you would. Anything that's generating 20% a year, why would I sell it? And they're incentivized through that. So for instance, Boyd's management team is incentivized or rewarded through the return on invested capital, which is a metric you never hear bandied around for management compensation. So we really think alignment's important to this model. You cannot buy acquirers if they're not aligned.
That's really rare to have that direct alignment of interest between yourself as a manager and target CEOs and their firms. It's something that you'd expect in, quite frankly, you might actually see in some larger companies as well. But it seems like most of your tilt is on small and mid-cap firms. Does this create a natural capacity constraint for your strategy? We're only talking about 6% addressable audience in the demographic in the market. How does the team feel about that in terms of the growth of your fund?
But when you take that 6% and you put it over 4,500 companies, you can see we can get to a couple of hundred companies that we think are on our list. And that changes and expands and contracts at times. We have the ability to grow the fund up to about 5 billion, but there's a limit. You're absolutely right. If you want to play in this area, if you wanted to grow it further, you would have to give up return. And I think that's a really important distinction, that the type of companies that we look at are really unrecognized, the small and medium cap ones. They've been around a long time. As I say, they have 10-year track records. The management team is very, very seasoned because they don't really need the sell side. They're not raising money. They're not issuing equity. They're not raising debt. The sell side gets less interested in them. There's not much there for the capital markets, not many fees there,
Yeah.
And
It's
so
not sexy. It's just not sexy, right?
Right. And also modeling an acquirer can be difficult. How do you model M&A, especially if I've got the CEO that's super disciplined and he won't do anything? So you tend to get them unrecognized and left aside. As companies get bigger, they get more recognized and they get the coverage goes up, but they also have less ability to deploy all of their capital. So when we see this basket of what Morgan Stanley or somebody would call compounders, and there's about 100 of these companies in there, and they're fairly well known out there, they produce some pretty good returns. They'll produce the market plus a couple hundred basis points. And that's because they're able to still generate that cash and they're still able to find good investments, but they can't reinvest all the cash. They're now down to that 50% area, and that lowers their overall return. So a mature, recognized compounder is one that really can't deploy all of its cash. An unrecognized, smaller company can deploy almost all of its cash at very high rates. There's a very good example, a company called Constellation Software, which rolls up vertical market software. And when they were $3 billion in deploying this M&A model, most people said, oh, this is a terrible idea. It's M&A, and all these M&A companies, they destroy value. And they're now 40 billion. And of course, the analysts love them. And they have one of the best returns in the market ever. And the analysts love them. But they're mature. And so the CEO came out, and he's become a bit famous now, Mark Leonard. And he said, we're bigger. We can't reinvest all our capital at the same rates. We're going to have to lower our return. And that's the big thing about a compounder model is you can get that predictability. He says we can continue doing exactly what we're doing, but we're going to be doing it at a lower return. So you, investor, will get a lower return going forward.
But do you see it in the books, Scott, or are you waiting for that newsletter to come out, that annual letter to come out from the management team saying, hold on, guys, look, we're now at tail end of the S curve. We're still going to be generating great returns, but our acquisition model doesn't allow us to target or acquire or find, those 20+% IRR type of candidates? Or do you see that happening ahead of time? Because I would imagine the moment that this news hits the reel, you're going to see some selling pressure in the market.
Yeah. And that's the job of the active management, is to monitor those companies, to understand the total addressable market. That TAM is such an important part of what we do when we're looking at 20 companies and you talk about a concentrated group of companies. We're really studying the TAM of 20 companies. And that is a big, big task and not an easy one, because if we're looking at Boyd, and we talk to the CEO and he says, we've got thousands of companies, and then we have to do our own research. How many of these exist independently? We know there's one other competitor. We have to verify that. And you get trust in management, but everything needs to be verified for our investors. And so we're out there looking and making sure that if they're going to be an acquirer in the software market, the food services market, the auto body repair market, that they do have that runway that allow us to hold them for 5 years. If we're holding a company for 5 years, it has to have a runway of at least 10 years. You can't hold a company for 5 years and have a runway of 5 years, or as you say, that tape bomb will hit at some point and the valuation will be destroyed.
Yeah. Is there a sniff test? I mean, it sounds like you do run very deep due diligence by remodeling the roadmap of what management has laid out for you, and you test that in your own modeling. Are there any other intuitive that your team's experience has taught you that would flag and filter out the other 94% of the candidates, some of whom may be incentivized to present a story that you would like?
We find that CEOs that aren't as disciplined, so they aren't able to, they decide to pay up more because they see an acquisition and they're paying 5 and then 6 and then 7, and they're not chasing the market, but they're staying active. And they don't recognize that as they pay more, they're lowering the overall return. So that is one type that kind of excludes from what we would look at. And then there's the one that uses the different sources. So as we say, there's 3 sources for your acquisition. There's your own cash, there's issuing equity, and issuing debt. We have extensive evidence, and McKinsey has done even some very similar studies, that serial acquirers should be using only their own cash. And there's lots of great stories of those that blow up that use debt, because of course debt has that famous moment when you can no longer borrow anymore and everything collapses. But there are CEOs that see this model, and this is a grow rich slowly model. And you could add a little bit more juice to it if you just put some more debt, but that again shortens it and also creates a higher probability of collapse. And then there's a CEO that says, well, if I just issue a little bit of equity, we can make this acquisition that's just probably a little bit bigger than I should. And so we get that stretching feeling on that. So there are lots of things that we monitor. We monitor the size of the acquisition, monitor frequency of acquisition. We monitor, did a CEO go from a decentralized and all of a sudden he's integrating this one? What's going on there? So it's amazing the life this has taken. And when you start looking at acquirers, even looking at that total addressable market, we look at, is the TAM fragmented? Will these companies become available? We talked to one CEO who was adamant and had the cash in with a great acquirer. But as it turns out, the companies he wants to acquire just don't come available all that. And so his penalty was he'll sit with cash for a very, very long time. And that just doesn't make for good compounding. Mm-hmm. So there's a lot of things in there to monitor all the time to make sure that you stay on the path. But again, back to the two main points we look at, a long, consistent track record and a well-aligned management team do a lot of work for you. But not to say you don't have to do everything else, but those two really help.
So let's talk about the global footprint that you have, right? We talked about a Canadian company, you've addressed some of the US firms. Now, I did notice in one of the newsletters, or in your last newsletters, you're looking overseas to Eastern Europe as well. So two questions. One is, what kind of companies and how is your model deployable in other countries where there may or may not be as much transparency? And how are you managing those investments, out of the UK?
The UK is a great spot for managing investments. So when we opened the firm, we had a few choices, but the UK has that wonderful time zone for it that allows you to capture a bit of the Far East and all of America. Your day is long, but you can capture a lot of what's going on in real time. So we really like being here, and getting to places is very easy for us. We have built the model so we can drop almost any country, any sector into it and see what drops out of it. And disclosure is very important. If we don't have the disclosure, we just can't do it because we're in the public markets and we need a certain threshold of disclosure or else the model just doesn't work. We don't have the information. But as more countries come online and become a developed economy, and Poland is a good example, as you pointed out, we moved into there and we found a company called 𝗜န့𝘃𝗲𝘀𝗁𝗲, which we think is a wonderful company. And they're a rollout model. So we're very similar retail rollout. They're opening a set group of stores every year. You can't convince them to do more. They stay very, very disciplined, and they're looking to fill a niche in Poland. So there you've got some keywords there. We look for the niche. We look for the rollout. We look for a great capital allocator who measures right down to his square foot of cost of capital. And all of these things, and he's perfectly aligned, and he's done this for a long time. So we're more than happy to go into that market, and the disclosure is very high. I will say that in our research on acquirers and where they exist and where they live and how they act, countries have a culture, and some of their business cultures don't really permit roll-ups. And we found that some countries have an overwhelmingly weighted more amount than others. The Nordic region or Canada, of course, the US is the biggest pot of capital out there and for investments. But when you look at the Nordic regions, it seems like it's a very well accepted strategy. In Germany, it's not a strategy that people like. Rolling up the middle of the market. Germany is a little bit frowned upon. Italy happens a little bit. France is full of a lot of bureaucracy, so that doesn't happen as much. Portugal, there's a little bit. Spain, UK, of course, provides a great background. We have yet to go into a place like Japan, which you and I have talked about. We think presents some wonderful opportunities, and people exploring that already. Getting around the cultural thing there is one thing we'd have to do. China's market is probably growing far too fast right now to really separate those that are reinvesting to acquire, and acquisition isn't in front of everybody's mind. The market is so big there. So yeah, we can put this around the globe and figure out who's doing what pretty quickly. And the other thing that we like to do is just as good fun is when there is a public acquisition, we can dump it in really quick and tell you right away, this will not work. So it makes it that we can come to that conclusion very quick. So it's good fun that way as well.
Very good. Yeah, look, I think that's all my questions on the book and the strategy. Is there anything that you think is worth mentioning? I mean, looking over the next 6 to 9 months, how you as a founder now as a business owner, looking to grow the shop, You've been at this for a while now, and you yourself have run a very, very disciplined team, very balanced, and you've been disciplined in focusing on, wow, actually, it's only been two products. And in fact, it's the same strategy, but one is protected, one is long bias, and both have done quite well. Are you looking at launching any new products in the future, or are you sticking to your guns here?
I think what we want to do is find some more like-minded individuals. We have a great client base. COVID was a time where it slowed everybody down. But if you're a firm like ours, as you mentioned at the beginning, we are a boutique. We do a specialized function here. And although we're $1.5 billion, that's in today's world, amongst some of the sides of the pensions, it is very boutique. But we think our strategy really fits with a lot of the institutional high net worth type investors. And so our goal has been to get back out on the road post-COVID, to go tell people the story. It's being very well received. It's different. It sits nicely alongside as an alpha enhancer for a lot of, so as a business, that is really our goal. We feel very good about the strategy and what it's able to return. And of course, we're very aligned with it. And then from a markets perspective, everything is pointing at a correction or normalization in small and mid caps relative to the super caps. What's happened over the last 6 months where small and mid caps were outperforming by 4 to 6%, depending on how you measured it, and then went to underperforming by 12%. So a 16 to 18% swing in 6 months is the biggest I've seen in my 32 years. And it really goes against the grain of market cap premiums, which small and mid caps should get because they do grow faster than super caps. So we do think that divergence is going to close. We do think that the risk premiums that are out there right now between the different sectors should close down, and that should favor the companies that we're involved with. So it's a nice tailwind to have to the strategy we have. And understanding that the Fed is probably done is good because that adds certainty. We can start pricing things. Yes, there will be the fallout from those that need to refinance, but for the most part, if you can start pricing the capital structure with any sort of clarity, then you can start making that this is rich, this is cheap, and start moving things around. So that's what we're looking forward to most.
Yeah, but you don't think we're near that point yet, do you?
I think you need people to get their heads around that the interest rates are stable. And once they do, then the stock picking can genuinely start. The sorting hat comes out again. You'll start seeing movements. And that's when I would think you'd see a correction in the Magnificent Seven, is when interest rates are stable. Right now, it feels very safe to be in very big companies, but that doesn't last. I've seen that many times in my career, and we know. And so that's why for this strategy, it's a very good time. Generally, even if we were to go into a recession, most of the small and mid caps are very much priced for a recession. So I don't think there's a lot of downside there, but closing that gap to the super cap is something that I look forward to.
But more of a personal question, I guess. You've been at this for a while. When you look back as a founder, if you were to have 5 minutes with yourself back in the day when you first started the firm, what advice would you give to young Scott Davies embarking on this journey into a galaxy far, far away?
I guess starting this journey, I would say, if you build it, they won't come unless you let them know that you've built it. So I was very much that it's all about the returns. Don't worry about anything else. And I'm very glad I did. But I would put it, if you build it, they will come only if you tell them that you've built it. So that was what I would tell them. So go out there early, tell people that you've got a strategy, talk to people, build the relationships early. That would be my advice to my younger self.
Do you think it's harder to start a hedge fund today or harder to start a hedge fund back in 2006?
I think it's incredibly hard today. You know, I was very fortunate. We were at the tail end of the hedge fund boom. There was a lot of resources, a lot of services available to us. Adam and I had very good careers. We had a lot of support from our existing employers and friends in the industry. So that was very helpful. But everything from regulation to cost these days makes it so difficult. And I think it can still be done, but the numbers are just that much bigger. And so from where we started, and Adam and I own the firm and we incentivize everybody who works here, but that's very difficult now. It'll be very difficult to own your own without some outside source of capital and help and everything else. So we're very proud that this is completely independent. So we have nobody calling the shots but us internally, and our employees are completely aligned. So everything's in the right direction that way, but I couldn't imagine doing it again, trying to start it again.
That's what I like to hear. As long as you have a chip in a chair, you have a chance. And even with the cost the way they are now, that I think will wrap it up, Scott. Thank you so much for your time. It's always an incredible discussion with you, and, looking forward to the next one.
Yeah, likewise. I love sitting down with you and can't wait to get back out to join the next one.
Great. Thank you very much. And we'll see you on the next one.
Bye-bye.